Good evening, good afternoon, and welcome to the Ascender Traders Group. This is our 30-day stock market challenge, and we are on day 16. That's right. We reached over the hump. We've got new software. We got our program. We're solving some of our technical issues. And 30daychallenge.ascendertraders.com is the blog. 30-day challenge.ascendertraders.com. And we're on day 16. The blog should be fixed with our comments and the links working properly, and we're ready to move forward. So, as we all know, Ascender Traders, our big thing is trade plans, and we are getting out of this loser's guide to online investing, and Ron adopted an approach to making investment decisions. And it's funny, but the question is that any different than what you do? If you don't have rules, you don't have a criteria, then you are just guessing. You are trading maybe off emotions, maybe off a hot tip, maybe off your friends, whatever. But if you don't have decisions and rules and criteria that you've set up yourself, it's not a good trade. A good trade is one that is entered and exited based upon rules and criteria, regardless of the expectations, regardless of the outcome. So, the question, this is really a question of what type of system do you really have? You may be just like Ron. So again, we are looking at moving averages. This is the second part of that video, and we're going to talk more. We're going to get out of the what are moving averages and how to use them. Again, we use them to follow trends. We use them as sorted report and resistance identification and confirmation. And of course, we use them as a part of our trading system. We want to get out of what they are, and we want to get in more today about how we're going to use moving averages. Now, some people like to use the 10 moving average. That's probably for the short-term investor because it's a 10-day moving average, it's going to be weighted closer to the more recent activity compared to the long-term effect. 50 moving average is going to be more for that intermediate investor. It's not going to feel the fluctuation of big moves in and out on a daily basis. It's going to be a more smoothed out moving average. And our long-term investors use a 200-day moving average. And I color-coded it because those are colors I use. My 10 days are green, my 50 are red, and my 200 is orange. Now, what I'm leaving out of this is your preference on whether or not you want to use a simple moving average or an exponential moving average. Remember, from part one, the exponential moving average puts more weight into what's happened recently than it does in the past. So, but they rarely will you see a huge divergence between either one of them. They're both going to be in the same area. So you're going to have to determine which one you like, simple or exponential. But these are the typical. Now, I also use a 5 moving average, and I also use a 20 moving average. But we're going to get to that in a second. You can see here on our picture here, we're looking at how we have the 10 moving average. In this situation, it is the red one. I'm sorry, the blue one is a 10 moving average. And notice how close it is to the stock. Notice how close it is to the stock. The 50 moving average, a little bit further away, because and so it's not feeling this fluctuation. It doesn't see this at all. So it's much smoother line. And here's the 200-day, even further away from the stock. And it really doesn't feel any of this. It's a real nice, almost a straight line. And again, the short-term investor uses the blue line, intermediate the red, and the 200 is the long-term. And a lot of people say that the institutional traders use this long-term moving average. What's important is to look at how the stock acted. When it broke the 10, it really did break down. And then where did it bounce? It bounced off the 50 moving average, came around. Remember what we talked about, support become resistance, so the support of the 50 moving average now became resistance, couldn't break through, and where did it go? Boom, down to the 200 moving average. Came back up, and now it's going back and forth. So again, we talked about the trend. Obviously, the trend that ended here as it broke through. We talked about support and resistance, support and resistance. But again, what we're going to talk about now, as I pull up my charting program, one of my charting programs, we're going to talk about more about the rules of how we can use them as a part of our trading system. So you can consider to buy a stock long as long as the underlying stock is above the moving average. That could be part of your buying signal, part of your criteria to go long on a stock, is it above the moving average? On the flip side of that, if it's below the moving average, you can either use that as an exit signal because it's broken down below it, or you can use it as a signal to go short on a position or to buy a put. Again, as a part of your rules, this could be a part of your rules. Is it below? Is it above the moving average? As these stocks come closer to a moving average, you can try to play that confirmation of the trend or the confirmation of support and resistance. Is it going to bounce down, bounce up, or are we going to get a breakout? So you can consider ending positions as they approach a moving average. And then finally, you want to look at the fact that when these moving averages cross each other, what does that do? When the short term crosses a long term, how does a stock react to that? Let's go ahead and take a look at. Okay, so the first thing I want to talk about as we have our charts up here is this is what I call my short term template. I have the 5, 10, 20, and 50 exponential moving average. Again, I have the 5, which is this yellow line. That is the 5 exponential moving average. I have the 10, which is the green line. The 20 exponential moving average, which is blue, and the 50, which is red. Again, this is part of my short-term template. This is the template that I look at every stock with to begin with. Every stock, when I go through my rules, when I go through my templates, I start off with this template. And truth be told, this is basically somewhat based off of Marquet Latimer from Better Trades. Basically, she's the one who introduced this template to me. And all I'm looking at when I look at this template is, where is the stock in relationship to the moving average? Obviously, the market's in the downtrend, so I'm looking to see where it is. Is it pushed far off? You can see right here where the moving average, where the stock pushed away. So when it pushes away from a moving average, that tells me maybe it's overbought, oversold, depending on where it is. Here would be oversold. Probably not a good time to get into a stock. Remember what we said. As stocks approach the moving average, that is when you need to make a decision about whether or not you want to get in. Now, the other thing is to notice the trend. So as we look at this stock coming down from June, you can see really the 20 moving average was the resistance line. So when it broke here and ran to the 50, I believe this is when we said, let's play going from the 20 to the 50. And it came back down, and once again, the 20 became resistance again, and we're moving down here. Before I move on and talk more about the crossing over of the moving average, let me switch over to this template. And this is my long-term view of the stock. This is where I'm looking at just to see where the stocks are. Now, this long-term view is skewed as the market is right now. Here, I have the brown is the 100 moving average, and now it's just a simple. Here is the 200 moving average. It's supposed to be an orange color. And finally, I have the 500 moving average. A friend of mine, Lydia, started me using this also from First Wave, Dave Elliott. And I still have the 10 exponential moving average. Even though I'm paying attention to the long-term ones, it's good for me, I just think, just to see what's going on down here also. And again, all I'm really looking at this is when I go from the short term, I used to be able to say, all right, stock's making a move. Let's go ahead and look at the long term to see if it's going to come into resistance. So when this stock was moving up, I could say, well, it's still got plenty of room to go to get to the 100 if it breaks the 50. So that's what I'm looking at. I'm looking at where it is short-term and long-term at the same time. Now, unfortunately, with the stock market pushing down so hard, that affected how well some of these moving averages is. As you can see, these stocks are nowhere near the 150. So when these stocks really started pushing down, that came into play. Now, you guys know that when I do my videos that sometimes we'll talk about it bouncing off of the 100 to 200 or 500. So I'm looking for long-term support and resistance when I look at this template. I start here, look at the stock, see where it is today, and I don't have today's chart up here. And then I switch over to here to see where it is long-term. Now, the final thing to talk about, again, is moving averages are support and resistance. They confirm the trend. And the other thing to look at is when a stock crosses over. Okay, so I've switched to the Dow Jones, and I'm back in October 2007. The last thing to talk about with moving averages is to look when the shorter term moving averages, the 5, the 10, the 20, whichever one you're comfortable with, when they break down the longer term ones. So when they broke down through this 50, this was the beginning of the end. Here, we got a little bounce, but you notice that the moving average never broke. When they broke through, that is when the stock went down and the market went down. So look for when the moving averages cross.